It won't let
Oh
me.
my
There we
goodness.
go.
Okay, so you can only share your screen, but I can record.
Correct.
Oh,
It looks like it's recording now. I believe Andy's the host.
Oh, okay.
okay, beautiful. All right, so let's move on then. And just to provide a brief overview of our webinar today, we're going to begin by discussing the potential housing shortage, followed by the demand for low and mid-priced rentals, real estate prices, vacancies and bad debt rate, increased demand from investors, and finally, what should you do? So first up, the potential for a housing shortage. So I'm sure everyone here has seen it in the news. We've been seeing it a lot in media. There is currently a mismatch between the housing that Americans need and the housing that is being built. This is due to expensive tariffs on building materials and a current labor shortage. Builders are choosing to allocate their resources to pricier homes and condos in order to stay profitable. This is resulting in a surplus of luxury homes and a shortage of low to middle income housing. Additionally, a competitive housing market is pushing up prices on starter homes. A limited supply of low to middle income housing will drive these prices up. Slow and halted economic growth is going to prevent companies from increasing their wages and increasing their headcounts for apartments and condos. This is overall going to lower consumer purchasing power. And a question that we have is, while we can be certain that supply is diminishing, will the economic crisis drive down demand proportionately? And looking historically, typically it's never proportionately. This isn't a question we can really answer, but it's important to think about going forward. So now for demand for low and mid-priced rentals, we believe they're going to remain steady over time. Prospective buyers will be more drawn to the renting market. An economic crisis raises a great deal of uncertainty, as many of you know, and the affordability of mortgage payments, future home value, etc., all raises a really uncertain risk for a lot of people. It becomes a more attractive option for older residents especially, and young couples who wish to be in the presence of amenities or downsides. Stagnant wages and an increase in student loan debt will make it even more difficult to pay off a down payment, all making the renting market even more attractive. And if we could just refer to the figure on the left here, we can see that blue line is median rent in the United States, and that red line is median renter income. And as you can notice, from 2009 to all the way to 2016, we can see there is a ginormous and significant discrepancy between rent and income. Rent typically being significantly higher than income. Overall, we see a recession. Our recession will cause vacancy rates in Class A properties, which is of the highest quality, highest amenities, to rise. And we will further talk about this in the next slide.
So economic crises can affect real estate prices, but the prices also depend on a variety of factors, such as, the supply and demand, government influences, etc. So these prices can either go up or down. Every recession is different from the previous, and home prices can even vary across the market. If we compare our recession happening now to previous recessions, like the one in 2008 with the housing crisis, we can see that the recession was centered around real estate, which caused a housing bubble. Statistically, home prices were increasing rapidly because people kept buying houses, and then they suddenly declined because people found themselves unable to afford the rent. As of today, real estate prices seem to be very steady or increasing in states like California. The government is aware of what happened during the last recession, and is doing everything in their power to prevent the same mistakes as before, which is why we don't see huge dips in housing prices now. Housing prices can also vary depending on the location. For example, metro versus rural areas. Luxurious houses will be hurt more. Houses in New York or San Francisco compared to already depressed cities like Cleveland. Real estate prices also differ for newer homes versus existing homes. Newer homes are more at risk because in a recession, home developers can go out of business or leave homes unfinished building. Not many people are looking for a brand new home during a recession, especially if the house prices are increasing. If they were to buy a home, they would much rather prefer to buy an existing home because it'll be cheaper. So real estate prices can really depend on the type of recession that we're in. The next topic is on vacancy rates and debt rates. Vacancy rates can be defined as the percentage of available units in rental properties. This is a good factor, although not the best factor, to measure the markets over a house. So during a recession, vacancy rates are expected to increase because many people lose their jobs and become unemployed. They have significant reduction in wages, causing a number of tenants to move out or even be evicted because they can't afford their rent. So these tenants end up relocating and moving into cheaper buildings or sharing houses or moving back with their parents, etc. This causes more space or rental properties to open up. It's also rare that new tenants are looking to move into these now open units because unless they were able to save enough money or afford buying a new unit during a recession, then no one would be able to afford moving in. This especially happens in Class A properties, which are considered luxurious buildings. Like people tend to cut entertainment or luxurious expenditures and settle for something less during a recession. Furthermore, we will see an increase in bad debt rates. As I mentioned before, some tenants will not be able to afford their rents or pay back all of their loans. So these non-paid rents affects the tenants and cause them to have bad debt rates. In some cases, if the tenants can't pay back their rents or any type of missed payment, then it puts serious liabilities on the lenders or the landlords to find a way to pay for the rent that the tenant missed. If you look at the graph on the right, they're kind of small, but if you see the peaks for both the vacancy and debt graphs, you can see that those occurred and spiked in 2008 had a recession.
All right. Elisa, thank you very much for sharing that information. Very, very true that as we deal with what is really an unprecedented economic downturn that we're experiencing here, not just in like the severity and the sort of like extremely condensed time frame that it's taking place in, but also the root causes being this huge externality, the global pandemic coronavirus. Very true that as we, experience like this widespread economic downturn, this recession that it's become now, there's going to be increased defaults. There's going to be fewer people being eligible for loans and things like that. And this is a common thing in a recession, but it's almost kind of ironic because along with the increased inability for people to make payments on current mortgages or current loans, and the inability for people to afford a down payment on a new house or be eligible for a mortgage in the first place, all of that's happening. Mortgage rates are actually falling. So they're falling, but lending restrictions are in parallel with that, they're also tightening. So it's almost kind of ironic. So in the end, it's definitely a negative on the economy and on the finances for individuals. So, economic contractions, they reduce the borrowing rates, interest rates fall. When we're looking at houses specifically, one of the very common rates, something that's significant to just about anybody buying a home, in the 21st century is the mortgage rate. So the opportunity to, for people to refinance homes when it comes to these declining rates, that is something that they're able to take advantage of because this is reorganizing old debts rather than taking out new loans for additional housing purchases. So these current homeowners or people with current outstanding mortgages, if they're in a healthy enough financial situation, so they're not on the edge already or anything like that, they may be possibly eligible for refinancing and being able to get a lower monthly payment. Kind of looking from it for a big bank perspective or a Wall Street or investor perspective. At the same time, if they're refinancing, that leads to prepayment in mortgage-backed securities. So you can experience a contraction on the maturity dates for different mortgage-backed securities. So those investors might not be too happy about that, but those who are eligible for refinancing are definitely going to be happy that they can secure a lower monthly payment in the long run. A very common benchmark for the overall state of interest rates for the U.S. economy, and I'd say really the world, is the 10-year Treasury note. And it, over the course of 2020, has hit all-time lows. If you guys take a look at the graph on the right side of the screen, titled there, Breaking Below 1%, just about the entire last 3 months, it might actually be the entire last 3 months, or a little bit more now, actually. But the 10-year Treasury note has been below a 1% yield for that time. Checked it just a little bit earlier today, and it's just above 0.75% yield, which is a little bit above how low it got about a month or a month and a half ago, or a little bit more now. But at its lowest, when it was in, around 0.6% yields and things of that nature, it had lower rates than in the 2008-2009 economic recession, the Great Recession, which, if you all remember, was the cornerstone of that. Really was a housing bubble burst. And now you're having, interest rates and mortgage rates that are even lower than that. So it's really a testament to how severe and how impactful the coronavirus has been on the economy. And like I said, refinancing, individuals hoping to refinance are very in a better position, I would say. They're very eligible overall to be taking advantage of these. We've seen especially large swaths of millennials choosing to refinance, and they're getting rates that are maybe 50 to 75 basis points below what they're previously paying, and of course that's beneficial for them. But as we'll see on the next slide, the tighter lending restrictions is making it very difficult for people to be eligible for new mortgages. So like I was just saying, banks are being more selective about who qualifies for loans, and this really all boils down to the type of metrics that they're monitoring when they're deciding whether or not someone's eligible. So some very common ones are LTV, the loan to value ratio, changes in the individual income, because while the interest rates are falling, the holistic economy has been taking a huge hit. So unemployment is through the roof. As a result of that, people have been losing their sources of income. They've even lost savings if they were invested in things of that nature. So just because the interest rates are falling doesn't mean that the people who were previously eligible are in the same position financial health-wise, and as a result, they're not going to be eligible for, or the majority of those people are not going to be eligible for the loans that they would have been maybe a year or 6 months ago. So many bankers and other lenders today still vividly remember the Great Recession, which again was largely attributed to excessive issuances of loans. So the bankers themselves almost have, I don't want to say the bankers necessarily have maybe a moral compass, but sorry to anybody who's a banker here today. But definitely they're concerned and they're monitoring themselves, they're restricting themselves. But on top of that, there is stricter legislation in effect that is obligating the banks and different credit agencies to be very careful watching who they're loaning to and things of that nature. So they're restricting themselves, but also there's legislation in effect that almost mandates in a way that they be more cautious in who they're lending to. So just to kind of summarize all of that, refinancing, it's a great opportunity to refinance if you're in a holistically healthy financial position. And if you're still in a healthy enough financial position to where you can be eligible for one of these attractive, mortgage rates on a purchase of a new home or something of that nature, whether it be commercial or residential. If you're in a holistically healthy financial position, you may very well be able to take advantage of these new loans at this time and be able to secure for the next 15 or 30 years, whichever you decide, on a very attractive mortgage rate, interest rates over that time.
Sorry about the technical difficulties there, folks. So there is the possibility of a positive impact that comes from economic crises. This may sound counterintuitive at first, the idea of some positive coming from such a large negative, so try to follow me here. What we could start to see is an internal capital flow toward real estate. The next moves we could see investors start to make are to pull their money out of the stock market and put their money into real estate. The reason for this switch is because if you look at trends throughout history, real estate is proven to be more stable than the stock market. Real estate returns exceed stocks with significantly less volatility. Actually, since the early 70s, real estate has beaten the stock market nearly 2-1. Getting back on track, we will specifically see more capital flow into multifamily real estate from local US investors. Why is this the case? Recessions force more people to rent, and when you can house multiple families on the same lot, your investment will grow a lot faster. The result of this trend is that it will counter the decline in demand for multifamily real estate, which as of April, the demand is 240,000 units, 20% less than 2019's demand of 300,000 units. To support this claim of reversal and decline of demand is the fact that although multifamily transactions, unlike other sectors of real estate, have decreased in 4 out of the past 7 recessions in comparison to only 3, it has seen the smallest decline across all property types. Also, the increased capital flow into multifamily real estate might even stabilize or prevent major decline in property value.
Okay, so we've given you a lot of information here, but what's next? What should you do? Well, we suggest that when you're analyzing prospective deals, really look at it conservatively. Consider the fact that vacancies are rising and Americans are starting to get into pretty bad debt with unemployment. Furthermore, we suggest looking at Class B and C investments. We kind of touched on this earlier, but these Class A investments, which are higher rent, higher income earning tenants, they are going to be the first to experience vacancies, so we really suggest staying away from those. Additionally, we suggest being more conservative with income projections, and you may want to consider giving bigger discounts in order to bring in your new tenants and keep the ones you currently have. Furthermore, we have noticed that suburban investments versus urban, those are going to have lower vacancy rates and higher rent growth. So we would really suggest looking at the suburbs.
And that's all we have for you today. Thank you so much, everyone. Thank you so much for your patience. Thank you for your attendance. We hope everyone has a better and clearer idea of the state of today's real estate market. Now we'd like to open up the floor for questions. If you have a question, please type it in our chat box, and one of our team members would be really happy to answer. And again, just wanted to reinforce, please ask it in the group chat. So Leland just asked, what do we expect to do about the wave of foreclosures? Does anyone have anything they want to add? The only thing I would most probably add is from an investment point of view, I think with the proper research, I think we should be taking advantage of the foreclosures and to upturn them and sell them for profit. I think that's a possible opportunity for real estate investors to take advantage of. If anybody wants to weigh in here, that's great.
Yeah, Nia, I definitely agree with everything you just said. If you're an individual who's a real estate investor and you're fortunate enough to be in a position where you don't really have to worry about living, paycheck to paycheck, or you have plenty of savings even amid the coronavirus recession, and you're actually in a position where from an investor perspective, perhaps buying the dip in whether it be prices of a company's stock or in like the decline in like housing prices and things of that nature. If you're in a position like that and you're really like holistically financially stable, foreclosures are an excellent opportunity to purchase homes at attractive rates. On the flip side of that, if you're someone who's at risk of a foreclosure, that really goes down to, I guess, not necessarily like economic or, holistic financial analysis, but really goes down to your personal finances. And of course, the most important thing you can do is cut your costs. If you've got maybe all of the different streaming services, maybe boil it down to just one or none. Maybe just go to some nice free YouTube videos or something like that. But when it comes to stuff like that, just anywhere you can cut cost, anywhere you can manage your personal finances to limit your cost, and perhaps there's certain things where you can rearrange some of your finances to stabilize your income sources.
That's a great point. But Elisa, go ahead.
Sorry. To add on to that, it's I would agree that it would be a great time to invest if you're capable of, because every recession has an end, and eventually, and as a result, your home value will appreciate, and it's good in the long term for a long-term investment. So if you have the money right now, I would say go for it and invest and buy your houses at a low.
That's a really good point. And I just quickly wanted to add on to what Andy was saying. In our last webinar, we were talking about refinancing and restructuring and how millennials are actually really taking advantage of specialized refinancing structures and deals right now. So in order to prevent, as a preventative measure for foreclosures, it would definitely be interesting to take advantage of the record low mortgage rates and consider refinancing as well. I'm not seeing any more questions in the Zoom group chat yet, but if anyone does have any questions, even towards the end of the call, feel free to email us, feel free to contact Leland or the investments team. We want to thank you again for attending our webinar today. We really appreciate the live audience, and we really appreciate the opportunity to be sharing this information with all of you right now. Thank you, everyone, and have a wonderful afternoon.